Welcome to the All Financial Hour podcast with Steve All.
Welcome to the show, folks. Glad to have you here with us. Happy 2025 out there. I think we can still say that. Second week of January. This is, of course, the All Financial Hour with Steve All. My name is Jessica. We have so much to get to on today's show. I'll get to that in just a moment. But, Steve, welcome back, my friend. How you doing?
It's good to be back in the office. It's hard to get here. A little snow this week. We take about a week and a half off for Christmas holidays because I just looked at it, go be with your family. Let's shut down the offices that week between Christmas and New Year. Got to spend a little bit more time with Megan up in New York City. Got called Grandpa for the very first time.
Oh, my gosh.
That was probably the neatest thing.
That 100%.
The very first time.
We don't even need to talk about
Grandpa.
anything else. You've won. Yeah.
And then it went from there. So that was fantastic. So that made my whole trip to New York City for Christmas. And then seeing a child that's about 3 months away from being 3 at Christmas.
Oh, my gosh.
Seeing Christmas through the eyes of a child is
beautiful.
Just amazing because it's been a long time for me since that happened.
Mm-hmm.
But the first couple ones, it's like, I don't really know what's going on. She knew what was going on this year. And then I come back, and I have never been to Wrigley Field. Now, I grew up in Indiana. My mom was a diehard Cubs fan, but I had never been to Wrigley Field. Mm-hmm. So we go up to the Winter Classic. The hockey game in Wrigley Field. And it was funny because the lady sitting next to me, there were Chicago people and blues people, a lot of blues people up there. But the lady sitting next to me, she goes, "It's a little chilly here." And I looked at her and I said, the last time I was at a Winter Classic, it was 49 degrees cooler than it is right now. And it was like 37 degrees because when it was up in Minneapolis, it was 12 below.
Oh, wow.
That was cold. I will admit that. I didn't dress quite as well for the one in Chicago because of the difference in the temperatures. But now I've been to 3 and they've won all 3. So I just can't wait for them to schedule another one because I know I have to go. They've won all 3 times.
That's right. You're the lucky charm.
So
yeah.
I'm the lucky charm. So as it comes from there. And then our son Matthew, our newest grandson, I got a granddaughter, now I have a grandson, was born on January the 2nd.
Oh, beautiful.
So I became a grandpa again. So it's like, wow, how can we have a better holiday season from that?
My gosh.
Be called Grandpa.
Yeah.
Watch the Blues win in historic Wrigley Field. That was an amazing place to be. And then become a grandfather again.
Congratulations there on your new grandbaby. A lot of folks I know have been talking to you, even, during the holiday season, Steve, saying, hey, look, this guy won the election. Doesn't matter if you're for or against him. Should I be changing my direction of my finances based on who's in the White House? Well, Schwab's Liz Ann Saunders told Yahoo Finance, not necessarily. Listen to this.
I don't know if there should be any adjustments specific to this election-related and policy-related uncertainty, because then you're trying to sort of game what's going to happen and then in turn guess what the reaction on the part of markets is going to be to what we are guessing will or might happen. So I think that's fraught with peril, and it's kind of a fool's errand.
Okay, well, interesting here. So, we talk about how you may have to make some changes with your finances, based on your own personal life or even the economy. But what's your thoughts on all this, Steve?
We heard a lot more about the elections before the election. And history shows us that the presidential election, there's not a lot of difference between whether there's a Republican or a Democrat in the White House. They seem to get a little bit more done when one party's in complete control. But in my opinion, neither side of the aisle has done a very good job of spending the money that I send them for taxes. I believe they both overspend. They just overspend on different things. So I believe that when we're looking at investment, we have to look at that timeline. I'm not looking to invest for 1, 2, or 3 months. I'm looking for the long term. And then when I look at the investment side for my clients, it's give me the best return that I can get with the least amount of risk possible. That's what I love about MarketGuard. I've got ETF portfolios. I can go static, where they just adjust for drift. I can go tactical, where they'll actually go defensive when markets say that it's time to do it. And for my more aggressive clients, we have stock portfolios, individual stock portfolios. So let's look at it. Growth if that's what you're really looking for. Dividend. What about emerging technology? What's the bet on these things that are going to be happening in the future? Don't have a lot of clients in it, but I have it available. Blockchain and custom notes. So I believe that having a big opportunity for people to do different things within the market, depending on how aggressive or conservative you are.
We have a list of the top U.S. places to retire in 2025. It comes from the U.S. News and World Report. Here's the top 5. Number 1, Naples, Florida. Number 2, Virginia Beach, Virginia. Number 3, this is shocking, New York City. Number 4, Sarasota, Florida. And, of course, number 5, Boise, Idaho. Steve, you've met with clients for decades here. Some come in and they go, hey, we're picking up everything and we're moving to a new place. How is that conversation factored into considering how their financial plan is laid out?
Well, let me get to that one in a minute, but let's slip that Naples, Florida right off the top, because
Okay.
I'm going to say, if you're thinking about moving, it's a lot more crowded than when my parents moved to that area in the Bonita Springs between Fort Myers and Naples 40 years ago. Traffic's terrible down there right now. My wife spends the winter down there. Please don't go to Naples. Go to the other places.
Go somewhere else.
That way we have it. No, it's absolutely wonderful there. It's usually warm all winter long. That's why my parents settled there, and that's why my wife goes there. But we start to look at moving to another city. Some of the things that I think people need to make sure you look at. What are your expenses? Is that cost of living going to get you going? It's a lot different in Naples, Florida, if you live in Old Town Naples or you live in East Naples. Big difference in the cost. You might want to rent first just to make sure you're in an area that you want to be. I think that is the most important advice we've given to most people, because what happens, I want to buy a house, and then you go out there because the kids are there, and all of a sudden the kids move and go somewhere else. Now you got to get rid of a house. And I believe that retirement is a journey, not a destination, to grow and protect a smart portfolio so that you can enjoy the retirement you're looking for.
The word annuity, it often gets a bad rap in the financial world. Critics tend to group all types of annuities under one umbrella. But if you're a listener to this show, you know better, because you know that's not true. So, Steve, for somebody who's new, let's break this down. What is an annuity? And of course, like with everything, there's always pros and cons. Give it to me, Steve.
The word annuity, I know as soon as that mentioned, some people grow horns because Uncle Joe's told them a horror story about an annuity 10, 15, 20 years ago. Somebody gave all their money to an insurance company. They died and they got to keep it. That's usually the one with most people hear the word annuity. That's what they think of. So let's look at the different types of annuity, because as you said, there are more than one types. Single premium immediate annuity. You do hand your money to an insurance company, and they're going to pay you a guaranteed income for the rest of your life, and if you do it for you and your spouse, for the rest of both of your lives. To get rid of that Uncle Joe story that I told, there's usually period certains where you're going to get guaranteed that you're going to pay it for 10 years. So if you die at 2 years later, they don't get to keep your money. They're going to pay it out to somebody else over time. The variable annuity. Variable annuity, your money's in the market. It goes up within market. It goes down with the market. There's usually a little bit more expenses in the variable annuity because of the fact there's administrative fees and there's a management fee inside of the annuity. So the annuities can have a little bit higher cost. Fixed annuity. A fixed annuity looks a lot like a CD. It's with an insurance company, not with a bank. And they're going to pay you a certain rate for a certain period of time. So that's a fixed annuity. The fixed indexed annuity, your money's not in the market. It's sitting in a bond portfolio, and they use the dollars that they're not guaranteeing they're going to pay you anything to buy an option. Whatever the index they're using is up, it's yours. So for that, there's limits, because your basement, I can't lose money. So there are limits on the amount that you make. The idea that I have to look at for annuity is you got to give me the right tool for the right job. I don't need an income producing annuity if my Social Security and my pensions are above my cost of living. I don't really need that. I'm buying something I don't really need. But if there's a gap between those two things because you don't have that company pension that a lot of people have, and all of a sudden you do the numbers and your cost of living, I'm going to say, is $6,000 a month, and your Social Security adds up to $4,000. You got a $2,000 gap. Mm-hmm. Could I put it in an annuity and have a life insurance company guarantee that gap? Yes, it's possible. I call it a personally funded pension. You're putting your money into it. It's not guaranteed by the company that you work for. It's guaranteed by an insurance company. If you need an income guarantee, I think it's a wonderful thing. And then the other thing that we like to use it for is principal protection. The fixed index annuity cannot go down due to market volatility. So I can never have a return of less than zero. That's what we call asset protection. Only has the availability to go up. The worst thing you can get is a zero. So, depending on your situation, everybody's situation out there is different. If you need income, an income paying annuity would be very good for you. If you want principal protection, there's a great way to do that too with that fixed indexed annuity. So the idea around it of it is, what do you need and will it fit? I don't believe it's the end all be all for everybody. But I think if somebody's very conservative and looking for asset protection, but they want some growth, I think it's a wonderful tool. If somebody's got a gap between their lifestyle and their guaranteed incomes in retirement, an income annuity could fit in very well. If you're not sure, you have an annuity that you don't know exactly how it works.
This is interesting. Actor Seth Rogen, he usually makes us laugh. He's the comedian in the movies, but he and his wife, Lauren, they are actually out with a very new documentary. It's called Taking Care, and it chronicles their journey in taking care of Lauren's mother who has Alzheimer's.
It's very expensive, and it's hundreds of thousands of dollars a year to really give someone good 24-hour-a-day in-home care. And to most people, hundreds of thousands of dollars a year is not an amount of money you just have laying around to spend on something that is not giving you anything other than like some slight sense of normalcy. You know what I mean?
I think we do know what you mean. And, if he's that, bombarded of the costs and he's, worth hundreds of millions of dollars, imagine us regular folks here, right? I mean, because nobody wants to leave this financial burden for a family. We want everyone to be comfortable and taken care of. And it's also a sensitive conversation, right, Steve?
It's one of the hardest conversations to have. It's also why I'm in the industry. I wasn't always on this side of the table. I had an advisor for a lot of years. But when my mom got Alzheimer's, there was no plan for that. My dad went to somebody and they sold him products. Well, the products that he had bought didn't fit this thing. So I had to look at it and say, God, you're helping business people run their businesses, but you're not helping people like your parents. So I switched. And I think this is an area that our industry has done a very poor job in. You have straight long-term care insurance. It's use it or lose it. It can be very, very, very expensive. Why? Because they quote Cadillac plans. If it's a $12,000 facility a month, we'll get you a policy to cover that. And people look at the price and say, I can't afford that. So you look down, maybe I didn't need the Cadillac. Maybe I could just use a VW. And then now they have annuities out there that have enhanced benefits that, God forbid, you have that long-term care exposure, that you have something to do it. And they have life insurance. And it's always easy for me to talk to somebody about covering themselves with either straight long-term care, an annuity with an enhanced benefit, or a life insurance contract that if they can't do it, the chronic illness rider kicks in. It's easy for people like me. I've got one of each. I had the original when they had it, and then they came out with the annuities, and I also like the life insurance because I look at it to the point I don't want to pass that burden on to my children. So if you're concerned about the cost of long-term care and you want to know what the other options are more about, just use it or lose it.
Steve, this is a question I know it's kept you up at night a few times. Where in the world does chocolate milk come from? Believe it or not, this is actually a survey people were dying to know the answer, apparently, by the Innovation Center of U.S. Dairy. And here is influencer Doug Sharp with the astounding results. Listen to this.
And what they found was 7% of Americans think chocolate milk comes from brown cows, which doesn't sound like much. But if we expand that number across the whole of the American population, it would mean around 23 million people think chocolate milk is brown cow milk. The survey also found that half the people who answered didn't know where chocolate milk came from.
All right, so I don't know whether to laugh or be terrified. it's neither here nor there,
So are
right,
you
Steve?
telling me it doesn't come from brown cows?
Oh, I hate to be the one to break it to you live on the air here, but it doesn't, folks. Come on. Come on. But,
That's
just
fallacy my father told me years ago.
yeah, you've been believing it for 60 plus years. Here you are.
Yeah.
Well, it got me thinking about different myths in life, whether it's about this or what have you. And it got me thinking about, retirement myths that I know are out there that people don't even question. They just believe it. So this is where you come in, Steve. What are some of those popular myths?
I think let's go through them fairly quickly here at the end. I think the one that Social Security is going to cover my expenses. Social Security wasn't designed as a retirement plan. It's an old age survivor's disability insurance. So it will not cover all your expenses. It's amazing when I tell people that Medicare is not free. A lot of people think Medicare, as soon as they get 65, they got no more medical cost anymore. That's not true. The other one that we bought into and we were sold a long time ago is you're going to be at a lower tax bracket in retirement. Well, I don't believe that's going to be true when the debt keeps climbing and climbing and climbing. We're going to have to pay the pauper someday. So the idea around it is that I believe by reducing or eliminating taxes, it's the best thing that you can possibly do for a successful retirement plan.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.